Hey everyone, and welcome back to the channel. Today, we are diving into a topic that's on everyone's mind: the escalating tensions between Iran and Israel and their immediate impact on global crude oil prices. This geopolitical situation is creating significant ripples, and we are going to explore what it means for the Singapore stock market. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. First, let's understand the core issue. The recent escalation between Iran and Israel has directly impacted global crude oil prices, largely due to heightened market anxieties over potential supply disruptions, especially through the vital Strait of Hormuz, a narrow choke point through which 1/5 of the world's daily oil supply transits. Historically, conflicts in the Middle East cause sharp, temporary oil price spikes, often driven by a fear premium. For instance, Brent crude briefly touched $74 per barrel after the June strikes. While some analysts, like JP Morgan, project prices above $100 or even $120 a barrel in an all-out confrontation, others like Goldman Sachs maintain a more conservative outlook, forecasting WTI at around $55 a barrel by year-end. This divergence underscores market uncertainty. Now, why is this so critical for Singapore? Singapore is a trade-dependent economy with no indigenous natural resources. This means it's highly susceptible to fluctuations in imported energy costs. Elevated oil prices directly translate into higher inflation and increased operational expenditures across many sectors here. The manufacturing and transport services sectors are heavily affected by energy cost shocks. But it's not all doom and gloom. This environment presents a dual investment theme. You can look for direct beneficiaries of higher oil prices, or you can assess the resilience and strategic adaptability of companies facing increased costs. We're looking for companies with strong financial health, diversified revenue streams, effective hedging strategies, and a commitment to the global energy transition. Let's break down some key Singapore stocks to watch, categorized by their oil price sensitivity. These are the companies that see their fortunes directly rise with crude oil prices. Rex International Holding Limited. As an oil and gas exploration and production (E&P) company, its financial performance is intrinsically linked to crude oil prices. A 10% oil price fluctuation impacts its profit or loss by about $29.81 million in 2024. Its share price has reflected this, seeing a 78.9% increase over 1 month and 49.7% over 3 months as of June 20, 2025. They use put options to manage the risk of significant price reductions, primarily as a defensive measure. RH Petrogas Limited. This company boasts cash flow dominance, with positive free cash flow and a remarkable debt-free status, holding 56.5 million Singapore dollars in cash. This gives them immense financial flexibility. Their return on capital employed was 40% in TTM 2024, which is 8 times higher than the oil sector average. Analysts estimate the stock is 20% undervalued, seeing the Q1 2025 earnings dip as a buying opportunity with rising oil prices as a catalyst. These companies benefit indirectly, either from increased spending in the energy sector or by focusing on alternatives that become more attractive with higher oil prices. Ceatrium Limited. A global engineering solutions provider for energy infrastructure, Ceatrium benefits as higher crude values stimulate offshore exploration and production spending. They secured significant contracts for FPSO units and reported a net profit of 157 million Singapore dollars in FY 2024, a substantial turnaround from a previous loss. Crucially, Ceatrium is actively diversifying into offshore wind, hydrogen, and carbon capture, offering a dual play that hedges against long-term shifts away from fossil fuels. Analysts see a 41.7% upside from its June 2025 trading price. Keppel Limited. As a diversified alternative asset management firm, Keppel's infrastructure segment, which includes renewable energy assets and natural gas power plants, has been its best performer. Higher oil prices boost demand for these alternative energy sources, contributing to revenue growth. They plan to double Singapore's power generation capacity to 3 gigawatts by 2030 and are monetizing legacy marine assets to expand renewables. Morningstar analysts estimate a fair value of $8.60, indicating a 19.1% upside. Sembcorp Industries Limited. A major energy supplier, Sembcorp is aggressively growing its renewables capacity, reaching 17 gigawatts in 2024 from 4.1 gigawatts in 2023, with a target of 25 gigawatts by 2028. A significant 51% of its gas-powered contracts have tenures exceeding 10 years, providing insulation from short-term market volatility. This makes them a relatively stable energy investment. These companies face significant cost pressures from rising fuel prices, but many have strategies to mitigate these impacts. Singapore Airlines Limited. A major airline, SIA, is highly exposed to fuel price volatility, which comprises a significant portion of its operating costs. Their net fuel cost increased by 309 million Singapore dollars in FY 2024-25, and their hedging strategy swung from a gain to a loss of 55 million Singapore dollars in the same period, highlighting the risks of active hedging. Despite this, they reported record revenue of 19,540 million Singapore dollars in FY 2024-25 due to resilient demand. SATS Limited. As an aviation and food solutions provider, SATS faces operational cost pressures from rising fuel and utility expenses. Their acquisition of Worldwide Flight Services, WFS, for up to 1.3 billion euros significantly increased debt to 3.5 billion Singapore dollars in FY 2024. However, they reported a net profit of 243.8 million Singapore dollars for FY 2025, a substantial improvement, driven by increased scale and integration synergies from the WFS acquisition. Comfort Delgro Corporation Limited. This public transport operator's fuel and electricity costs were 397.2 million Singapore dollars in 2024. Crucially, fuel expenses within their public bus contracts are generally indexed. This contractual mechanism acts as a natural hedge, limiting the direct impact of oil price changes on their profits. Samudera Shipping Line Limited faces direct pressure from rising bunker fuel costs, exacerbated by global events like Red Sea diversions. They use a bunker recovery mechanism to apply surcharges based on bunker price fluctuations, which acts as a natural hedge despite a time lag. They are also investing in newer, more fuel-efficient ships and exploring greener fuels for long-term cost reduction. Singapore Shipping Corporation Limited. This company is engaged in the broader industry trend of decarbonisation, with a radical shift to embrace bio-LNG energy. While this entails significant capital expenditure, a new LNG dual-fuel PCTC can go from $70 million to $110 million. It represents a long-term commitment to reducing future exposure to volatile fossil fuel prices. The impact on these sectors can be complex and indirect. Wilmar International Limited. Its exposure to oil prices is indirect, mainly through its oleochemicals business, which uses tropical oils like palm and coconut oil. The prices of these oils are influenced by the broader energy complex and biofuel mandates. Challenging operating conditions for tropical oils impacted their feed and industrial products segment's pre-tax profit in FY 2024. China Aviation Oil, Singapore Corporation Limited. As the largest purchaser of jet fuel in Asia Pacific, CAO is directly involved in oil products. A crucial point is its history, a $550 million loss in 2004 from speculative derivatives trading. However, they have fundamentally revised their trading policy to strictly hedge physical cargoes, implementing a 4-tier management control infrastructure to prioritize robust risk management. This overhaul is key for investors to consider. Chemical Industries, Far East Limited. As a chemical manufacturer, its operational costs are inherently sensitive to energy prices, as many industrial chemicals are oil-derived. The available information does not indicate explicit hedging strategies for commodity price volatility, making its profitability more directly exposed. SP Chemicals Limited. A significant petrochemical producer, SP Chemicals operations are highly energy-intensive and directly reliant on oil-derived feedstocks. Their 2022 annual report noted high energy prices as a market uncertainty. They are also investing in an integrated petrochemical park and a naphtha cracking plant, tying their future to commodity prices. Beyond specific companies, remember these broader points: company-specific hedging and risk management. Companies vary greatly in how they manage oil price exposure, from active hedging, like Sia's fuel hedging, to passive, pass-through mechanisms, like ComfortDelGro's index contracts, or structural advantages, like RH Petrogas's debt-free status. Understanding these is crucial. Broader market risks. The Iran-Israel conflict could lead to wider regional instability and more severe oil supply disruptions. Sustained higher oil prices could trigger a global economic slowdown or recession by reducing consumer purchasing power and elevating business expenses. And even if oil prices moderate, domestic inflationary pressures like wage growth in Singapore could persist, leading central banks to maintain higher interest rates, which dampens growth. The current geopolitical landscape is injecting volatility into global oil markets, impacting import-reliant economies like Singapore significantly. For aggressive investors seeking direct oil price upside, Rex International and RH Petrogas are key. RH Petrogas, with its debt-free balance sheet, offers exceptional financial flexibility. For growth-oriented investors focused on the energy transition, Atrium, Keppel, and Semcorp Industries offer compelling opportunities through their diversification into renewables and natural gas. For defensive investors seeking resilience in impacted sectors, ComfortDelGro with its index contracts and Samudera Shipping Line with its bunker recovery mechanism demonstrate robust cost management. It's vital to focus on companies with robust fundamentals, strategic adaptability, and transparent risk management practices. The long-term trends in energy transition and decarbonization will continue to shape the investment landscape, offering sustainable growth avenues amidst short-term volatility. What are your thoughts on these stocks or the current oil market? Let us know in the comments below. Don't forget to like this video, share it with your investing friends, and subscribe for more insights. Thanks for watching, and happy investing!